Hello, everyone. Welcome to my channel. If you're someone who likes buying strong companies during fear and correction phases, then today's video is for you. Because one of India's biggest IT giants, TCS, has corrected more than 50% from its peak zone. So the question is TCS becoming a value buy now, or is the IT sector still dangerous? Let's break it down in a simple way. First, let's understand what TCS really is. TCS is not just another IT company. It is India's largest technology services company and one of the most respected IT brands globally. From cloud computing to AI solutions to enterprise digital transformation, TCS works with some of the biggest companies in the world. And the biggest strength, this company generates massive cash flow consistently, has almost zero debt concerns, and regularly rewards investors through dividends. That's why many long-term investors treat TCS like a sleep peacefully stock. Why stock fell? Um, Now let's talk about the fall. Why did TCS correct so heavily? The answer is simple. Global IT spending slowdown. Many companies in the US and Europe are reducing tech budgets. Projects are getting delayed, decision making is slower, and discretionary spending is weak. Because of this, growth expectations for the IT sector have reduced sharply. And when growth slows in premium companies like TCS, the market quickly cuts valuations. That's exactly why the stock corrected deeply. Current situation, now comes the important part. At around 2,250 to 2,400, TCS is trading near a major long-term support zone. And this is psychologically very important because this is the phase where retail sentiment becomes negative, investors lose patience, but long-term money slowly starts accumulating. This is what markets usually look like before recovery phases begin. Now, one thing that makes TCS very different from many stocks is dividends. TCS is one of India's strongest dividend paying companies. For FY26, the total dividend payout is around 109 per share, and the latest final dividend announced is 31 per share. So while investors wait for price recovery, they are still getting strong cash returns regularly. That's why many long-term investors use TCS as both a growth stock and a passive income stock. But let's be realistic. Short term, the trend is still weak. This is not a momentum stock right now. The stock can remain sideways, volatile, or even retest lower levels if global conditions worsen. So traders should avoid aggressive entry. A safer approach would be to wait for a breakout above 2,700. That would indicate momentum returning. But long term, the story becomes interesting again because AI, cloud computing, automation, and digital transformation are not going away. In fact, over the next decade, these technologies will become even bigger. And companies like TCS are already deeply positioned in that ecosystem. So if the global IT cycle improves, TCS can slowly move back toward higher valuation zones again. Um, so let's summarize quickly. Short term, weak trend, wait for confirmation. Long term, strong accumulation zone for patient investors. This is not a stock for excitement. This is a stock for compounding. If you found this analysis useful, don't forget to like, share, and subscribe to the channel for more stock market insights. Thanks for watching, and I'll see you in the next video.